Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for March 2nd, 2025. I'm going to be using the new tool, Market MRI Pro, so that's why the title says that. And my new email address is marketmripro@gmail.com, although I still have all the other ones I've had, including the hgsidoc@gmail.com. Welcome you to this week's video. Hopefully it won't be an hour long. Part of the reason why I went with this new product, which I developed with my programmer Praveen, is because I could combine the best of so many different programs I had to go to gain certain charts and knowledge, and I think it allows me to skip most of the PowerPoint and after a couple slides go right to the presentation. If you're new to my channel, please click subscribe, hit the alarm, and you'll get notified when I present this. If you like this, don't like this, you got the up and down thumbs and plenty of places for remarks. If you have specific questions that you don't want to put online, you can email me at any of my email addresses and I will promptly answer them. As always, this is for educational purposes only. Anything I talk about should be taken in the spirit of education and not considered investment advice. The intent of the video is to show you and demonstrate the tools of top-down analysis and how I apply them. Trading involves risk. You are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky, and you should always consult with your financial advisors before making trades. And I have tools in multiple platforms, but consider myself an independent trader. I do, and if you're looking for the wealth charts video, and I'll be using it on some of the weekend videos as well. I'm going to vary, but since I'm launching Market MRI Pro this weekend, I thought maybe it'd be a good one to use. But if you're looking for wealth charts video, check it out Monday at Stocks and Docs before the market opens. Typically it's up around 8:30, and if you sign up on that little thing that pops up in the bottom, my good friends at becomeabettertrader.com will put you on a list so that you'll get it emailed to you each day when I post it. And I post them when I'm not traveling. If you like this stuff and you want to come to a live meeting, I do 2 of them a year. Always do the first one, which is in June in Orange County, and the second one depends on how busy I am with my day job, which unfortunately of late has been pretty busy. I guess that's not unfortunate, but it means it's hard to do some of the programs. This one is what we call the inexpensive program. It typically runs between $300 and $500 depending upon how many perks, meaning do we feed you and water you, or do we not just make it bare bones? And my guess is it'll probably be bare bones and closer to the $300. Typically we start on Friday, people come in on Thursday, we break Sunday around noon, and it's typically me and 4 to 6 other speakers. It's a great meeting for the price. Will we offer an online version? Don't know. Depends how many people show up live. Also, I have this group called Top Down Trader. I would love to have you join. It's not only is it free, you get $100 off Market MRI Pro when you buy it if you're a member at the time that you make the order. How do you join? You go to Google Groups, you sign in with your Gmail email, I guess, and then you search for Top Down Trader, separate words. Tell me how you want me to contact you from daily digest or single emails. Give me 24 hours, you'll be in, and then you'll get the discount on my tools. You'll get nightly videos that I don't always post anywhere else, commentary, and I've done and will do quarterly educational programs online that are usually 3 hours or longer, which you'll get to attend if you're a member of Top Down Trader, and if you're not, you'll get the recording. As I mentioned before, I have wealth charts. I have tools that I use in multiple platforms. HGSI is a program that I've been using for, gosh, has it been out 20 years yet? Probably. Great program. Everything I do, except for a couple of my trading systems, are built in. It has scanner. You can build a market timing model, has great market breadth tools. is really the granddaddy to me of the tech analysis programs that I use. Um, it is predominantly an end of day, but if you have a software feed, you can actually update your data intraday. Wealth Charts was the first package to put a scanner for me with my specific indicators that I like. I'm very thankful for that. And in exchange for that, I gave some of my indicators for free. And then we packaged the scanner with the multi-time frame of the bongo and a few other tools and put that as a marketplace add-on. It's a one-time purchase, although you have to purchase Wealth Charts on an annual basis. You can build a timing model. The only thing that Wealth Charts is missing, at least I can't find it, are some of the market breadth data that I use. It's a great product, and not only do you get a great product, you get a great team led by Rob Hoffman, Keith Wade, and others who are constantly teaching people how to trade and how to use the platform. TradeStation is a trading package you're all familiar with. Van worked with me to create a unique tool, which I call the Van Trading app, where he has developed it's not a radar screen because you could scan thousands of signals, and it's not a scanner because it doesn't break or give or time out, and it's fast. And we call it the trading app. And it's available for purchase. You'll see me demonstrating it from time to time. I've got my indicators as an add-on for TradingView, and soon to be for Metastock as soon as I sign off on that the indicators match my other platforms, and then the Market MRI Pro, which I'm going to introduce soft launch on Sunday night. If it wasn't a soft launch, I would have been sending out emails and invites and doing videos promoting it. But we're ready to come out of beta. We're looking for maybe 10 or 15 users, and then we will try and stress the system for a couple months, and then I'll open it up again. So, launch webinar Sunday night, link in the remarks section, or if you sign up for Top Down Trader, you'll get an email with the link, and oh, by the way, you'll get a $100 discount if you sign up for Top Down Trader. Price announced Sunday with special launch discounts. I don't really do this to make money off of selling tools, but there's a cost to a platform and a programmer that I need to take care of. And so I think we've priced it fairly. First year you buy the app and you get updates and data for year one. And then starting in year two, you'll have a much smaller annual fee for data and maintenance. And if you don't already have the TradingView indicators, you'll get that as part of your purchase. Now, this is not an indicator, it's an app. And by that I mean it is much more to support. I have fees to various vendors for code components, storage, processing. I've never had to rent server space before. And we have a real-time data feed for the program as well. And as I mentioned before, if you're top-down trader Google group, you get an additional discount of $100. And then I have stacking discounts. If you own the TradeStation app, I believe you'll get $200 off. Wealth Charts, $100. TradingView package, $100. And you can add those all up. The discount that you get for being top-down trader, there's a discount for being launch price. And that gets the price down significantly. And that's really because I don't like screwing the people who have bought it on other platforms. Why did I do this? Because I want more free time for the things that matter to me. And what matters to me is family, my grandkids. I like my boat. And I like Michigan football. Before we go into the Market MRI Pro, on the left, I always look at this. This is from Market Watch just to get a sense of what's going to happen in the week coming, and it's a busy week. I mean, we've got on Friday the jobs report, and there's been so many layoffs both from the government and in tech and in pharma biotech. At some point, we're going to see a spike, I believe, in the unemployment rate. That might take the heat off of a lot of the rate concerns. We have jobless claims and productivity on Thursday. Friday's the big job number. Wednesday, we got the ADP employment. We got a Beige Book. We got some ISM services and factory orders. And on Monday, we've got some final PMIs, constructions, ISM. And the arrows on the left are a lot of Fed speakers, including at 12:30 on Friday. Just what a way to end the week. Fed Chairman Jerome Powell speaks, and you never know what's going to happen when he speaks, but it's not usually good. And then if you look at earnings, we're still not done with earnings. And one thing that it's been pretty obvious to me, if you had good earnings, you really got rewarded. If your earnings miss on anything, you've been destroyed with 10, 15% or more. And think about how hard it is to win. You're going to have earnings and revenue for the current quarter. It's going to be compared to not only what has been published and predicted, but the whisper number. Sometimes you look like you beat it and the stock goes down. Then you're going to have to project future earnings and revenue, both for the next quarter and for the year. And any miss among this, margin prediction, that's what hit perhaps NVIDIA, and your stock goes down. So as it says in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It's just bad judgment to not know when your stock's earnings date is scheduled. So for example, one of my biggest positions is C Limited. It's had a great run. And if you look at my Outlook calendar, on Monday it says C earnings tomorrow before the open. So I know at 9 o'clock I'm going to get an alert on Monday. So at least I'm going to have to go look at my position and decide how to manage it. So I always try and build the earnings dates into my calendar so I don't have surprises. All right, told you it was going to be a quick PowerPoint this time. So let's go into Market MRI Pro. Upper left-hand corner is daily performance. You can see up here all the major ETFs, Qs, Spiders, Diamonds, and Russell that I look at, all above 1% on Friday. If you had looked about 12:30, didn't look so good, but there was a really nice rally into the close. I was actually going through Hartsfield Airport, and I was doing okay on Friday. At least I was positive a little bit. And then I got on my plane and I looked at about 3:30, and I hadn't looked for about 2 hours, and it was like, whoa, pretty good day. So we could see the market was strong. The VIX was down, no surprise there. You could see over here the strength. This is the closing range. And if you're bullish, you want to finish in the top part of your range. And we certainly did on the U.S. market indices. And what was at the bottom of the range is volatility. So for once, volatility was better. Over here on the right, we're looking at new highs and new lows. And you could see that we're negative at the multiple different time frames in both the NYSE and the NASDAQ. Negative means more new lows than new highs. Bull markets are not built on new lows. They're built on new highs. So that is concerning. You notice it says refresh. It's a Saturday night. There's nothing to refresh. We feed this with real-time data. When you turn on the program, it'll be real-time. But we don't update it with streaming. Why use the server space? I'd have to charge more money and use up unnecessary bandwidth. You hit the refresh, it takes about 3 seconds, and it will refresh as many times as you hit that during the trading day. Now, on the week, I can come over here and just rank them on the week, and we could see the winner on the week was the VIX. Here, the VXX of 3.38%, and only the diamonds of the major averages was positive, just short of 1%. And technology in the Qs led to the downside, minus 3.43. So Friday and the rest of the week looked very, very different. If we look at the sectors for a one-day change, and let's rank it the right way, first thing you notice, all of them were green. This is the S&P 500, so all the S&P 500 sectors were green on Friday, led by financial, consumer discretionary, energy. So this is a bit of a flip because real estate, healthcare, utilities, and staples, which is, I think we call it, here it is, were the ones that were leading early in the week. So we shifted to more of a risk on profile on Friday. If you look at the 5-day range in the sectors, you'll see financials, real estate, healthcare, industrial, staples. So over 5 days, more defensive looking than it was over on just Friday. Now, I also look at a bunch of themes here, and so MLPs looked really good in my review of 1,000 stocks on Friday night and Saturday morning, and no surprise, MLPs were up 3.27 as a ETF on Friday. Biotech starting to move. Semis surprisingly were up 1.73. Nvidia was down about 117 when I just said I'm not looking anymore for a couple hours because I was busy, and I'd put a collar on it and went back later. It was almost got back to where it opened. So you could see, we'll take a look at where it finished. The types of things that were up at the top. If I want to flip this, the laggards were marijuana, clean tech, solar, and now China, which had been leading, actually lagged on Friday. Lithium batteries, more China, social media. If you look over the 5 days, however, aerospace, defense, energy, preferred. Yeah, I'm surprised that China's not up here because we saw a lot of strength in China this week as well. All right, what else do I have here? Then I've got three indexes here, the S&P 1500, the NASDAQ, and the NYSE. There are four things asked about each of them. What percent of the sectors were positive on Friday? 100% of the S&P 1500 versus a much smaller amount on Thursday, 85% in the NASDAQ, and 100% in the NYSE. That's bullish. How many industries were up? 87% in the S&P 1500, 75 in the NASDAQ, and 82 in the NYSE. Again, bullish and a big improvement over Thursday. What percentage of stocks advanced? 78% in the S&P 1500, 60 in the NASDAQ, and 67 in the NYSE. It's interesting that the S&P 1500 is leading because if you think about it, it's got small, medium, mid, and large cap stocks in a different makeup of the other two indexes. The last one says how many stocks are above the midline of their Bollinger Bands. In a bull market, stocks seem to run up to the Bollinger Band and pull back to the midline, back up to the upper band and pull back to the midline. In a bear market or a downtrend, it's the opposite, where they go from the midline to the bottom of the bands back to the midline. So we have 38% above, 28% above, and 36% above. That just tells me that majority of stocks are below the midline and probably in downtrends. So this updated real time is awesome because you'll see things happening on the industries and the sectors where they're outperforming the cap weighted indexes and vice versa. You know what's working from an industry group or theme on the bottom, and on top you get the various sectors. Now, I start with my timing model, and this is something that I built into wealth charts and then expanding it to other programs. What's different here than wealth charts, it's simple. I don't have to move the buy-sell signal because it's automatically calculated for me here. We saw deterioration this week. We already were in sell signals on the Spider and the Russell weekly. We see the Qs broke down here the last couple of trading sessions, and we now have a weekly sell signal on the Qs. And the only thing that is holding on as a buy still is the diamonds, and that barely, because had it closed below the WMA, and it's only about 1% above it, it would have triggered a sell as well. And midweek, it was giving us a sell, which is why I say you have to wait to the end of the week. Now, these are the 3-month new high, new lows. If you look, they're not close to the bottom. The Qs is kind of getting close to where we see reversals. You see it gets low, we reverse. It gets low, we reverse. We're almost there on the Qs, getting there on the Russell, but really not there on the Spiders nor on the diamonds. On the daily, you'll see just by looking at the buy-sell line after it flips, Takes a few seconds to do the calculations. You could see on the daily that we are in a sell across them, and I'm just playing around with my tool, and you can draw the Darvis box and kind of wonder a couple of things. Are we in a Darvis box? And if so, we should bounce. And we bounced on Friday, which wasn't a big shocker. Then the other thing is, was this going to turn out to be a false breakout on the spiders, which would be very much akin to what happened with the Russell in 2021 going into 2022. Now, why does it make sense sometimes to be a long-term trend trader? These are monthly charts, and despite all the muck that's going on, going back to, gosh, we could go back really far. I mean, going back to 2013, 12 years, you could see on each of the monthly pictures here long-term uptrends, and despite what at times were very painful pullbacks, the COVID crisis, and so on and so forth, markets tend to go higher, and all of them are on monthly buy signals. So how do I put this all together today? This dominates to me. 3 negative and 1 positive, 3 sells, 1 buy. All dailies are sell. Um, you know, I don't have a clear story here that says go buy, 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 buy. Now I do follow canceling, and I think this counts as a first rally day. So if we see a move above 1% on higher volume, and I believe it will be starting Wednesday, I have to go back and look at the rules, that would be a signal to start buying. Right now, was Friday a dead cat bounce, or was it something more, which was the title of this presentation? Let's take a look at the index charts. We'll look at them one at a time. So I had this line up here at the all-time high. And then I looked at it and said, you know, we had this double top area here. Was this a false breakout and we're going to go down below the 200? It could have been. I drew during the week, are we going to go up to all-time highs? Are we going to bounce around here or go down? And unfortunately right now, despite the strong day on Friday, we got lower lows, we got lower highs. We're in a downtrend until proven otherwise. So the spider does not look great. You look at where is it going to go to. The 200 is not that far. This white line here is, I think, a likely destination, which is only about 10 points away, less than 2%. Give it a couple days, the 200 will be there, and let's see if we hold. On the other hand, can we go right back up and take out that 50 and go on to new highs? Absolutely. I have to say that since I am more bearish than bullish, I'm looking for targets to the downside, but I'll play the market that I get. And you could see here on Friday we actually had nice volume. There's the white bar there. All right, so that is the spider. If we look at the Qs, let's blow that puppy up. The Qs, great uptrend for quite some time. You can see it's recovered from some major pullbacks multiple times. It's had the pullbacks, and now it kind of feels like we're going sideways. It looked like early in the day Friday we broke below, but you know, we're right at support in kind of a Darvis box. Even though I'm not real bullish this market, my expectation is this thing's going to go higher. But a break below this line is going to be in itself a big story. If I look at the diamonds, here's a trend line. We're just above it. We took out the 50 on Friday. Do we go on to higher highs? Certainly can. I don't have a crystal ball. I think I still am concerned that we come down and we touch this line first. But can we go up to new highs? Sure we can. And, you know, I will adjust my potentially bearish stance based upon the data going forward. And despite the great day on Friday for the bulls, look at this candle. Wow, it's massive. 1.35 gain. Took out the 50-day moving average. Awesome, awesome, awesome. Despite all that, it didn't flip the daily timing model. The Russell, this has been the weak sister, has broken down below the 200. None of the others have gotten there. Had a nice reversal, but boy, lower lows, lower highs, lower lows, lower highs. Russell's in a downtrend. Can it break out and go to higher highs? Sure it can. But it's going to have to clear that 200 first. And I think that the 200 is going to be an area of resistance if it even gets that far. So I'm not sounding real bullish. I apologize for that. Now, what would be the sign to buy? Well, my buddy George Lee used to say when the VIX is high, it's time to buy. This is high. This was high. And when it's low, look out below. It spiked on Thursday, gapped open on Friday, or traded up on Friday and closed lower, down 7.67. That's not a picture that says we're done going down. We had the blow off and now we're going higher. Could be. I'd expect more damage before this is done. And then something that I did notice that I didn't like as a wannabe bullish investor was our dollar popped at the end of the week. And that is concerning because the market seemed to do better, at least the stocks that I own, maybe because there's a lot of small caps when the dollar stays under control. All right, I just took something for that cough. This is the time of year down in Florida when my allergies go crazy and my cars turn yellow. A black one and a white one, and they kind of look the same after a while. So the dollar going up is concerning if you want long the market and fits the scenario of higher for longer rates. Where do the tariffs come in? Inflation, so many things going on that are making this a difficult market to trade. If we look at the commodity ETFs with the dollar weak, the dollar showing some strength, you'd expect, whoops, wrong one, to see that some of these commodities might be selling off. You can see gold peaked early in the week, and on Friday it was down another 0.63%. So gold is giving it up. Oil is struggling at the 200. Silver is coming back to the 50. Natural gas, this might just be a flag after a pretty significant run, but it's pulled back. And then, unlike the dollar, the 10-year was actually well behaved this week, as was the 30-year, both closing near the lows of the week. So think about it. Why would rates be coming down when the Fed says we have inflation? We've got tariffs coming that are probably going to cause inflation, at least short term. Does somebody see something in the economy like a recession coming? I don't see it yet, but with the yield curve reversions, I worry about that. I think here's a case where falling rates may not be wonderful. Buckets. Something Ian taught us looking at the S&P 1500 was that if you take those Bollinger Bands and you make 10 deciles between 0% B and 1.0% B, you can get a sense of where the stocks are. If you notice before, I said most are below the midline, and if the midline is right here, you could see there's more stocks to the left than there are to the right. We actually eased some to the right, and you can see the gray lines are where we were on Thursday, and you can see stocks below the Bollinger Bands and stocks at the bottom got lesser in number, and we started moving to the right, where you're now starting to see a few more up at the top. And that was the same across each of the 4 ETFs here, or 4 indexes here. That is interesting because that would suggest that we had a reversal. Well, we did see a reversal on Friday. The question will be, is this a reversal that will continue and take us from a left-sided picture to a more right-sided picture and take us up to an oversold condition? I don't know. I think there's enough counter signs that I'm still worried we're going lower from here. And for those who haven't listened to me before, I am usually very bullish, and if anything, I'm a perma bull, which gets me into trouble sometimes. Here is a market breadth page, and so on the left is the NYSE daily, and on the right is the NASDAQ. They don't look the same. Where in the end of the year, in the beginning of this year, the NYSE sold off considerably, and the NASDAQ did not. Now you have the NYSE holding up and the NASDAQ selling off. Now I did get an email from one of the top-down group who asked about would we expect Hindenburg omens here, and I think it depends on which side I'm looking at. On the left, we're approaching all-time highs on a market that may have weak breadth. And what that means is, or based on those new high, new lows, is, hey, we had a Hindenburg here on Friday. Hindenburg omens occur at market tops. They represent a significant amount of volatility. Um, at the top, you have lots of buyers who are usually the guys like me that are independents, and the pros are selling. You get new highs and new lows and lots of volume. And the Hindenburg omen has been associated with every major market crash, but the majority of the Hindenburg omens have only small, minimal pullbacks. So we'll pay attention because we got one. I would not expect one on the Nasdaq, but we did get him back here, and it's kind of in the area before the market sold off. So what else do we have here? If we look down at this window here, you can see green shows you stocks above the 20, white is stocks above the 50, and red is stocks above the 200 moving average. At market lows, we start to extend to the downside. We're kind of neutral, heading towards the downside on the NASDAQ, which is no surprise because it's pulled back so much. Then we have a series of new high, new lows, advanced decliners, and up-down volume. So you can see on both the new high, new lows were negative. We already know that from the daily briefing. But you can see the advanced decliners have turned positive, as have the up-down volume. Now, we'll see if that's a trend that continues. And then lastly, I'll look at ratio charts to get a sense of what's working in the market. And what you're looking for, well, communications have been strong for a while, probably driven by Netflix, Meta. It eased a little bit on Friday, but it's been one of the longer-term great performers. Financials, especially KIE, on fire. Real estate has picked up a lot. Utilities has picked up, and so has staples as we've switched from a more tech-driven and discretionary. You can see tech has fallen off the chart, and discretionary. Now, these are not the sector charts. These are the sector ratio charts versus the spider. So I normalized them so I could see what's working now. I don't really care what the absolute number on a sector score is. I care how's it performing versus the market. So at this point, we're 33 minutes in. I've given you my thoughts on the market. I'm still concerned. We saw the rotation into the more risk on Friday. Was that a one-day wonder? We can see here that the defensive staples, utilities, and real estate are leading. Communications are doing fine. I already talked to you a little bit about financials. And something that often looks a lot like the staples or moves when staples move is healthcare. And I've been talking about those drug distributors for a while as stocks that, an industry group that holds up well if we go into a bear market or into a bearish decline. Now, you hear about stocks. I get that. So this tool has been developed for both top-down and bottoms-up. I prefer top-down. So if I'm a top-down guy, I'm going to first highlight what group I want to use. And I'm using the JAS group, which is the NYSE plus the NASDAQ plus the NYSE, and it's filtered to be more than $1 greater than or equal to $1 and more than 100,000 shares traded. And this number will change from week to week, and right now it's at 3461. We have sectors and industry groups attached to each of them. So when I look at top down, I have a list of the 11 sectors and then 144, I believe, industry groups. I also had a question, are these the same industry groups in HGSI? I don't know. I have to ask Praveen where he gets the industry groups from. He'll be on the video that we do in the webinar we do on Sunday night. I think HGSI uses Morningstar, but I'm not 100% certain of that. So the bottom line for that question is it all depends on where you get your data from. And even in every program, you're going to find things that are probably in the wrong place. Typically, it's something that was a ticker change to a stock that no longer trades. And that happened with Beijing in our program. It went to ONC. And the chart was really funny until I realized you had a ticker that ended it in 2018, and then you pasted it to the last 3 weeks, and it was easy to resolve. But every program has to deal with updates and changes and maintenance, hence why having an app is much more difficult and more expensive than having just an indicator and relying on somebody else's tool. So if we look at performance by percent change, financials, utilities, communication services come up to the top, then staples. If we look at industry groups percent change, we can see that oil, gas, midstream, financial conglomerates, wholesale distributors, independent power come up to the top. You'll notice there is no refresh button because we're going to increase this like every 15 seconds we update it. So is it real time? It's kind of real time. It's just not real time streaming. Again, we're conserving server resources and not wasting bandwidth. So you could see the strength of the day on Friday, and we go way down before we see any red on the 1 day percent change. Now, top-down trading, to me, means I could start over here and say, okay, financial services is number one. These are the stocks in financial services. These are the different sectors or industry groups in financial services. Now, I like to rank those by 2-day momentum. And what comes to the top, let's turn off this. We have financial data and stock exchanges, insurance, 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 asset management, 1, 2, 3, 4, 5, 6, 7, financials, financial credit, 10. So these are the top 10 industry groups in financial services. We could rank these also, the stocks, by 2-day momentum and take a look at some of them. Root, earnings came out. Now, this is a high flyer. I think it's a recent IPO, if I'm correct. You can see that's a monthly, so it came out sometime in early 24. Weekly chart, run up, pull back, run up. Look at this candlestick on last week. Wow. Now, what drove this performance? Well, we can look here, and we can open up the earnings. Earnings came out February 26th. This sort of surprised me because it kind of looks negative, $1.30. And I think the calculation, so I'll have to talk to Praveen on the calculation. It actually is massive growth because it went from negative to positive. And if you look at the revenue, it went from positive to much more positive with a big surprise. So Root is running because of its earnings. I like this a lot. Look at all the blue dots down here with the relative strength breaking out. OBV looks good. You've had breakout momentums, volume, gaps, new CPR signal, the EMS signals firing. A lot to like here. Not quite extended too much for me right now. So Root looked very good. And what I can do is add that to my hot list. Well, my hot list B is where I put the ones I'm interested in this week. BlackRock. I think people used to tell me where BlackRock goes, the market follows. Well, BlackRock has been pulling back. Had a great day on Friday. Up 1.48%. This white line represents relative strength, which is still about 80 on it. Take a look about earnings. We're just going to leave that on. You can see the earnings came out in January. Berkshire. Now this was also interesting. If the world is falling apart, why did this just break out of a rising trend line and rising tops and move up to, is it new high territory? Let's look at months. Um, I think this is new high territory on Berkshire Hathaway B. Um, I think Warren Buffett even said that buying stocks now wasn't a bad idea. But look at that. Now he had sold his spider positions and his ETF positions, so we'll see. And you could see earnings change 71%, 673 versus $3.92, almost a double. 59% of that was a surprise. You had a revenue surprise. No wonder it moved up so far. So Berkshire Hathaway looks great. Taking out this. Is it extended? Getting there. That's the only problem. Visa and MasterCard both look good. Big runs up, pulls, and a breakout. Let's see. Earnings are out. It came out January 30th, so they're behind us. Relative strength rank is 91. And it broke out after this little bit of a pullback. I like that one. MasterCard, it's already in my list. Same thing, sideways consolidation. You know, this is the kind of stock here that if I really wanted to be long this market, I might put a buy stop above the high there. And if it takes that out, I might look at that. Goldman Sachs pulled back, sitting on the 50, which Ian Woodward taught us was that was called free parking. You can see here, big change in earnings, 11.95 versus 5.48. It's a beautiful chart. Probably an interesting time to be looking at it. So I think that's already in my buy list. So from a bottoms up perspective, I could look at just financial services. I could look at the industry groups in financial services, or I could do something I like even more, which is to rank, let's see, I want to get all the sectors. Do we have to do that differently? Just reset it. There you go. All right. All right. So I'm running down. We're just coming out of beta, and I know there's a way for me to have opened up everything. So I'm going to have to ask Praveen before tomorrow's video. Okay. I've now got all the industry groups back here. So another way of doing top down, I could look at the left-hand side and do sector specific, or let's just do that 2-day momentum sort. And let's take the top 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You remember my comments about insurance, all right? It is 1, 2, 3, 4, 5 of the top 10 groups are insurance related. Probably says something about insurance, don't you think? And the next one would have been insurance as well. It's ranked by 2-day momentum. Booking, so the travel stock, the old price line. Big pullback, sort of a cup handle. Is it ready to give us a breakout? Here's Root again. Really like that one a lot. Here's a stock I don't understand, and I've said it before, and I know I feel like I am going against hot dogs, apple pie, and my mother by having anything negative to say about Costco. We all know this is one of the greatest retailers of our lifetime. And you just go to the stores and it's just amazing how packed it is. Beautiful uptrend. Beautiful uptrend. A little bit of a pullback. Actually looks kind of compelling here if it breaks above this line. Earnings are out this week, and here's what I don't understand. Its forward PE is 330.79 cents. Its revenue multiple is kind of flat. Its earnings multiple just shows how good they are as operators, are 30%. How do you justify that multiple? So as much as I love the chart, I've been afraid to enter it, and I keep kicking myself in the can because you could have said the same thing when it was 600. But talk about expensive. Now, I mentioned drug distributors. I've sold businesses to two of them, Cencora, which used to be ABC, and then the third one is the other one I sold to is Cardinal Health. This is the third, McKesson. You want to see beautiful? How about a monthly chart of McKesson? It doesn't look as good. How about, there you go. Let's give it some time. That is what I call beautiful. And notice we've had periods of time where we've consolidated for a number of weeks or months. I think this is another consolidation. We're going to break out and go much higher. Let's take a look when earnings are coming. Earnings are out. Positive change, although did not meet the expectations, and it's going up higher anyways. Earnings came out February 5th. We already looked at Berkshire. Humana surprises me because the healthcare insurers have been killed, but it had a good day on Friday. Nice little move up 3.44%. Earnings came out 211, horrible. Now, 125 to 211, that's a big positive change. Not really, it's a negative change from minus 11 to minus 216. So hard to understand why the earnings were up. It must have been news driven. OMI, Owens and Minor, kind of down in its pattern, another type of distributor. I know the oncology distributor as well. Yet a gap, volume, breakout, momentum, relative strength, and OBV look good. Earnings are out. I just get nervous when it's so far below the moving averages. So a top-down person might just select the top 10 groups and go through a couple of the insurance companies. Aon breaking out to new highs. In fact, let's see what else we got here. Allstate pullback, broke out on Thursday. Another big move on Friday. Look at the relative strength versus the spider. AIG, or is this AJG? Arthur Gallagher, insurance broker, breaking out. Here's AIG. Travelers, breaking out, not yet. Cincinnati Financial. So insurance companies are hot, as are the indices. Here's the CME, or the, not indices, what will we call them? Well, whatever they are. They're not asset managers. What do we see? Financial data and stock exchanges. Here's the CME with a big breakout. Surprised that United Healthcare is here because this is one that's been clobbered. But maybe they had the baby out with the bathwater. This was an announcement of a investigation by the OIG and the feds of information that I think was already out there. Maybe that's done going down. It got right into where it reversed from here, and it was up nicely on Friday. So that's what bottoms up or top down is. And I love top down investing. That's why I built this program. And everything that I just did on this right hand side is updated real time. Bottoms up, take that same list of stocks and filter. So one of my favorite scans, which will be named 2-day momentum, because it's not really kahunas and it's not the force, it's some combination. So let's look at stocks that are above 500,000 and in volume $5, and my 34.61 will drop to 20.58 or so. And then let's drop in some signals. Let's look at the 2-day force up, which will be 2-day momentum up in the next update. So we actually have a bunch here. So I'm just going to run through those, and then we're going to say adios, and hopefully you can join me for the launch on Sunday night. ACIW. Probably one of my favorite charts this weekend. Big run up, pull back, broke out off the 50 on Thursday. I wish I would have bought it then. Moved up again on Friday. We're getting into prior high area. Look at the blue dots that came in across the board. Look at relative strength at OBV. I think ACIW looks good, and it's not extended. Global Life is one of those insurers. Big swoosh down here. Nice recovery and breaking out to post drop highs here. Notice that each of these have these two blue dots above the yellow line. The yellow line was the squeeze, and the blue dots above it show me momentum, breakout, volume, doesn't have a gap dot here. Um, so that's a very bullish picture. MCW, Mr. Car Wash, I just can't buy this thing. It's cheap stock. Notice it too has the double momentum. MetLife, another insurer. This one has not broken out yet. We might be, I don't want that wrong thing, Jeffrey. Go back here and highlight that one. Okay, stop that. I'm still learning my way around my tool, as you can see. Yeah, I might want it to break out of that line before I chase it, but again, the double momentum. This one surprised me. 3M, old name, earnings $1.68 on 121 versus 242. Bad, although they had a positive surprise. Um, Breaking out certainly to 1 year highs here. Um, it's looked great, and I believe this pays a decent dividend too, which will be in here. Pays 2.79% dividend. PLYM, I bet that's real estate. Hard to buy something for me to buy something so far below the 200. SPR, Spirit Aero Systems. This is one where there's a lot of expectation that Boeing's going to buy it. Um, Not my favorite chart pattern, so it's got the 2-day momentum, which means it's probably going to go higher, even though I said it's not my favorite pattern. Kind of sideways. SRI, consumer cyclical, don't know anything about it. Again, maybe it's the beginning of something new, but this is a stock that dropped from 100 down to $5 and had a dead cat bounce. I'm not chasing. Visa, we talked about Visa and MasterCard looks great. Notice it's got the double signals here. VRN, which is, don't know this one from Adam. 100 is a relative strike. That's not what the price was on that other one. This one has gone in half. Don't know what they do. It's interesting. They got the two momentum dops. I don't care. And U.S. Steel, it's going to have to break above this for me to want to start chasing this or following this. But with the potential investment by the Japanese, who knows? It's got the momentum signal, and I'll tell you, it's the signal that's my go-to is when I see those two dots next to each other. I have a number of other buy-sell signals in here. Let's kill that one. One of my other favorite ones is called the CPR signal. Yes, I am a doctor. That's why they're all medical terms. This one requires the long-term be an uptrend, and then the short-term fires in one. Let's see by 2-day force what that is. Now, since the short-term just fired, it means it's probably not extended. There you go. Everything we do, root comes to the top. NXST, Organogenesis. ANIP is a generics company that had a breakout. So there are a number of different scans built in. For bottoms up, you've got the top down. More about this tomorrow. So let me just sum it up. I got to go buy root since it came on everything. I'm just kidding. I'm kidding. I probably will buy root, but you don't have to buy it. When it shows up on the top of every scan or every analysis, it makes you think that there's something there. I think the market's at an interesting position. As the title says, we had at least a dead cat bounce on Friday. How will I know it's more than a dead cat bounce? Well, sometime around Wednesday, we're going to get a follow-through day, starting Wednesday or after Wednesday, up 1% on greater volume than the prior day. That will add to my conviction. That'll probably flip my daily timing model to a buy. Then I'm going to start to get interested in the market. Right now, I might make a few attempts at starter positions with the high expectation of failure. And until the market turns around, I think going long is going to be probably the way to try it, but it's going to be tricky. Going short, you could go short here, but I think the market's probably going to bounce. If it doesn't bounce here, it bounces very soon. So to me, maybe taking it careful, trying a couple starter positions, the long and short size, nothing big, and let's see if we get a follow through day. I hope to see you guys on Sunday night. I hope you like the new tool.